You have upgraded your forecast for commodities, the most bullish on commodities since the end of the super cycle in 2008. What is behind that bullish call, and how does the market action we've seen in the last few days feed into that? Does it change your view at all?
No, absolutely not. In fact, commodities proved to work just as advertised. In fact, you saw base metals and gold trade up as the equity market went down. And I like to point out, we invented the Goldman Sachs Commodity Index, or the GSCI, for precisely this kind of environment. Strong late cycle economic growth. The second reason is you have a positive carry in commodities right now, meaning that oil is what we call backwardated, where spot prices sit above forward prices. So you buy at a discount and roll up the curve. In other words, it pays you to be long. And then the third point is you have no correlation across assets. We had negative correlation during the sell-off in equity markets. So the diversification argument is strong as ever. So again, during the sell-off, commodities performed just as advertised.
What about inflation? We start to see a tick up in inflation, if that does come through, and then we see more rate hikes than expected. How does that play into the commodity sector?
Historically, when you look at commodities, they perform very well during rate hiking cycles. It's kind of a tautology because it's the higher commodity prices that lead to the inflation that forces the hand of the central banks. But on average, the GSCI is up 19% per annum during rate hiking cycles. And we'd expect to see more of the same over the course of the coming years.
So rotate into industrial metals. That would be your call.
Absolutely. In fact, that during the rate hiking cycles, industrial metals are up on average 50% per annum. We did 30% last year. So we'd think again that in this type of environment, this is what commodities were intended to perform really well. And what we've seen so far is spot on.
Gold has only ticked up marginally over this market rout. Has it lost its safe haven status?
Historically, which is why gold is not a good hedge for inflation, is that when you see rate hikes, you typically see gold start to trend down. And it has to do with the fact that gold is negatively correlated with real interest rates. So I think about what gold is a hedge against debasement. So when the U.S. government prints a lot of dollars, as we saw in 2009, that typically puts downward pressure on real rates, which puts upward pressure on gold. The environment we're in right now is the Fed is raising rates. Now, historically, gold would go down. Why did it go up? It's the wealth factor in China right now. The demand out of Southeast Asia, in emerging markets more broadly for gold, is unprecedented, which is putting a bid into gold in an environment which typically gold would trade down.